On January 17, 2025, the world of cryptocurrency was introduced to a new contender dollar Trump. This audacious digital token, named after former US President Donald Trump, arrived with a wave of hype and fanfare. The launch was timed with Trump's inauguration, aiming to capitalize on his base's fervent support. Unlike Bitcoin or Ethereum, Dollar Trump's supply was controlled by a select few. 80% of the tokens were held by Trump-affiliated companies. Within hours, the price of Dollar Trump skyrocketed from $7 to $75. The Dollar Trump phenomenon defied traditional investment principles. Unlike established companies, Dollar Trump had no inherent value. Its worth came from its association with Donald Trump and speculative fervor. Dollar Trump's value was driven by sentiment, not substance. Despite this, Dollar Trump reached a market cap in the billions. This showed the power of branding, hype, and quick riches. Investors poured millions into Dollar Trump, chasing extraordinary returns. But this speculative frenzy was unsustainable. The extreme volatility of Dollar Trump became glaringly apparent. The price swings were unlike anything seen in traditional markets. These wild fluctuations defied conventional asset pricing models. The price was entirely at the mercy of market sentiment. The writing was on the wall. The meteoric rise of Dollar Trump was unsustainable, built on speculation and hype. The Dollar Trump bubble burst. The price plummeted, leaving significant financial losses. The crash highlighted the risks of hype-driven investments. The fallout was significant. Countless investors faced substantial losses. The Dollar Trump saga became a cautionary tale. The Dollar Trump saga was not just a story of speculative excess and market volatility. It also raised serious concerns about potential market manipulation and the lack of regulatory oversight in the cryptocurrency space. The initial token distribution, with 80% of the supply controlled by Trump-affiliated companies, raised red flags from the outset. This concentrated ownership structure created an environment ripe for insider dealing and potential pump-and-dump schemes. Critics argued that the promoters of Dollar Trump could artificially inflate the price by creating artificial demand or restricting supply, only to dump their holdings at the peak, leaving unsuspecting investors to bear the brunt of the inevitable crash. While concrete evidence of such manipulation is difficult to come by, the structure of the ICO and the subsequent price action fueled suspicions. Adding to the controversy, the promoters of Dollar Trump attempted to sidestep regulatory scrutiny by claiming that the token was not an investment. This assertion, however, rang hollow for many, as the entire premise of Dollar Trump was built on the promise of financial gain. The attempt to circumvent securities regulations by labeling Dollar Trump as something other than an investment highlighted the need for greater regulatory clarity and oversight in the cryptocurrency market. Section 5. The Dollar Trump Legacy, a cautionary tale for investors. The Dollar Trump saga, though seemingly an isolated case, holds valuable lessons for investors and regulators alike. It serves as a stark reminder of the risks associated with hype-driven investments, the importance of understanding tokenomics, and the need for greater regulatory clarity in the cryptocurrency space. The allure of quick riches often blinds investors to the underlying risks, and the Dollar Trump case highlights the importance of due diligence and a healthy dose of skepticism. The experience of Dollar Trump investors underscores the importance of conducting thorough research before investing in any asset, particularly in the volatile and often opaque world of cryptocurrencies. Understanding the fundamentals of an asset, including its intrinsic value, market dynamics, and the potential for manipulation, is crucial for making informed investment decisions. The Dollar Trump case also exposed the regulatory gray areas surrounding cryptocurrencies and digital assets. The attempt to bypass securities laws by labeling Dollar Trump as something other than an investment underscores the need for clear guidelines and regulations to protect investors and ensure market integrity. The lack of a robust regulatory framework creates an environment where unscrupulous actors can exploit loopholes and take advantage of unsuspecting investors. Section 6. Beyond the hype, understanding tokenomics and market mechanics. The Dollar Trump saga highlighted the importance of understanding tokenomics, the underlying economic model of a cryptocurrency. Tokenomics encompasses various factors including token distribution, supply mechanics, governance structure, and the intended use case of the token. A thorough understanding of these elements is crucial for investors to assess the potential risks and rewards associated with a particular cryptocurrency. In the case of Dollar Trump, the highly concentrated token distribution, with 80% of the supply controlled by insiders, should have been a major red flag for investors. This structure created an environment ripe for market manipulation, as evidenced by the extreme price volatility and the subsequent crash. Investors need to be wary of cryptocurrencies with opaque tokenomics, or those that exhibit signs of centralized control. Another crucial aspect of navigating the cryptocurrency market is understanding market mechanics. Cryptocurrency markets are often driven by sentiment, hype, and the fear of missing out, commonly known as FOMO. This can lead to speculative bubbles as seen with Dollar Trump, where prices become detached from any underlying fundamentals. Investors need to be able to distinguish between genuine market trends and hype-driven bubbles to avoid falling prey to speculative manias. Section 7. Navigating the regulatory landscape, a call for investor vigilance. The Dollar Trump saga underscored the need for greater regulatory clarity and oversight in the cryptocurrency space. The lack of a comprehensive regulatory framework creates an environment where unscrupulous actors can operate with impunity, putting investors at risk. While regulators around the world are grappling with how to best regulate cryptocurrencies, investors need to exercise vigilance and take steps to protect themselves. One important step for investors is to thoroughly research any cryptocurrency project before investing. This includes understanding the team behind the project, their track record, the technology underpinning the cryptocurrency, and the regulatory landscape in the jurisdictions where the project operates. Investors should be wary of projects that operate in regulatory gray areas, or those that make unrealistic promises of returns. Another important aspect of investor protection is the need for self-regulation within the cryptocurrency industry. Industry leaders and stakeholders need to come together to establish best practices, promote transparency, and work with regulators to create a more robust and trustworthy ecosystem. This includes implementing measures to prevent market manipulation, protect investor funds, and ensure the ethical development and deployment of blockchain technology. Section 8. The allure of the quick buck, separating speculation from investment. The dollar. Trump saga served as a stark reminder of the allure of quick riches and the dangers of speculation. The promise of extraordinary returns in a short period of time can be intoxicating, leading investors to make irrational decisions. It is crucial to distinguish between speculation and investment, understanding the underlying risks associated with each approach. Speculation involves betting on the price movements of an asset without regard for its underlying value. It is akin to gambling, where the potential for high rewards comes with an equally high risk of substantial losses. Investment, on the other hand, involves committing capital to an asset based on its fundamental value and its potential for long-term growth. Investors need to approach the cryptocurrency market with a long-term perspective, focusing on projects with strong fundamentals, a clear use case, and a dedicated team. Avoid chasing hype-driven bubbles or investing in projects that promise unrealistic returns. Remember that patience, due diligence, and a focus on value creation are key to successful investing in any asset class, including cryptocurrencies. Section 9. The future of digital assets, lessons learned, and the path forward. The Dollar Trump saga, while a cautionary tale, should not overshadow the transformative potential of blockchain technology and digital assets. The cryptocurrency market is still in its infancy, and like any emerging technology, it will experience growing pains. However, the lessons learned from the Dollar Trump experience can help shape a more robust, transparent, and investor-friendly ecosystem. The future of digital assets depends on building trust and confidence among investors and the public. This requires a multi-pronged approach, including greater regulatory clarity, industry self-regulation, investor education, and the development of more robust and secure blockchain infrastructure. By addressing the shortcomings exposed by the Dollar Trump saga, the cryptocurrency industry can move forward and fulfill its promise of creating a more inclusive, efficient, and innovative financial system. The Dollar Trump saga is a reminder that the cryptocurrency market is evolving rapidly. Investors need to stay informed, adapt to changing market dynamics, and approach this new asset class with a balanced perspective. acknowledging both its potential and its risks. By learning from the mistakes of the past, we can build a more resilient and sustainable future for digital assets.